So good afternoon, everyone. It's a pleasure to meet you. I hope you all had a very nice summer. And we are kicking off this season of a We Are In seminar with Enrichetta. And she is based at the Federal Reserve Bank of Chicago. And she will tell us about these weird investment strategies here. So I'm kind of keen to hear about that. And so I think the way we are going to do it is, if it's okay with you, Enrichetta, we can ask you a question during the talk if we have some. Yeah.
Absolutely, yes.
Very good. So we're gonna you're gonna have 1 hour all together, and we can, maybe we can have more discussion at the end. We'll see how many questions there are. Okay, so thank you so much for joining, and Enrichetta, go for it.
Thank you so much, Helene, and everybody for inviting our paper. This paper is joint work with Patrick Luo, who is at Farallon Capital Management, Marco Sammon and Luis Viseira, who are at Harvard Business School. Everything I'm going to say today does not reflect the views of the Fed, the Federal Reserve System, or Farallon Capital Management, for the better. So what do we do in this paper? In this paper, we study the behavior of retail investors, individuals as opposed to institutions trading in the market, and we study their effect on asset prices. Specifically, we are going to focus on momentum. And in case you're not in finance, momentum is a phenomenon that is being actually widely documented. Let me working perfect. So basically, there is a very, very large literature that documents momentum. Momentum is the phenomenon by which, if you look at the past and see what are the stocks that most recently ran up in price or went down in price, and if you invest in the ones that went up, the winners, and short the one that went down, the losers, you're going to make money. So in theory, if prices incorporate all the information that we have, then looking forward, you don't know if a price is going to go up or down. But in practice, companies that have done well in the recent past will continue to do well on average in the future. And companies that have done bad in the recent past will continue to slide down and go bad. And so if you take this into account, there is a trading strategy, right? Buy winners, sell losers. So we show that these retail investors do the opposite. They are contrarian. So when they see a winner go up a lot, they sell them. And when they see losers go down, they buy them. And with their behavior, they contribute to slowing the incorporation of information in prices. Because instead of the information, let's suppose I do well, instead of the price jumping up, let's say 5% on the spot, it only jumps up 3% because there are people trading against this incorporation. And then as time passes, the price eventually will adjust to the full increase. Why do we focus on retail investors? Well, do we focus on retail investors because they have been documented to be subject to behavioral biases, and we need some agent with behavioral biases in order to try to explain why all the information in announcements, news, and so on is not immediately incorporated in the price. Also, retail investors own a substantial fraction of the stock outstanding directly. So not only they own the stocks through mutual funds, but they also have stocks like Apple, IBM, and so on in their own portfolio. So if you look at the flow of funds, in 2001, they held 43.1% of the outstanding stocks directly. In 2019, 37%. It goes down over time, but it continues to be substantial. Finally, if you have followed the news during the pandemic, retail investors came to the fore also because of the GameStop, the meme trading. And so they have become an entity that people are more and more interested in studying, even per se, even without any other reasons. So let me summarize the findings so that then we can, if our discussion takes longer somewhere or we have a detour, at least I told you everything. So we use a large panel of US brokerage accounts. We have 2.8 million accounts over the period 2010 to 2014. What we find is that investors are contrarians. they sell stocks that have done well upon earnings announcements, and they buy stocks that have done badly. They do so especially for the losers. So they tend to, their buying pressure is much stronger for losers than the selling pressure is for winner. As a result of that, I will show you the prices don't fully react to the news, and it takes them a little time to go to their expected level. And so as a result of this, there is a return continuation. Instead of the prices adjusted immediately, it takes a little bit of time. And people, institutions mostly, but anybody really who is aware of this phenomenon can take advantage of this. If they see the price going to 3%, they know that it's gonna, continue up. And so they can buy at 3 and potentially sell at 5. Okay, so this effect is concentrated among poor earnings announcements and low past returns. Is stronger for small stocks and for stocks with low institutional ownerships. These are stocks where retail investors have bigger effect on prices because they are a larger fraction of the holders. And these are also stocks that are maybe not scrutinized as much by industry analysts, professional investors, and so on. And so these are potentially areas in which it takes longer for the information to be incorporated in prices. Finally, this behavior is persistent. In order for retail investors to have an effect on prices and to cause momentum, they need to trade against the price adjustments for a significant amount of time. It's been documented that usually momentum has an horizon of 6 to 12 months. So we need for this investor to be acting as contrarians for this period at least.
So Enrichetta, just one quick question. So what's the frequency at which usually the retail investor trade compared to institutional investors? Do they trade as frequently and they don't face high transaction costs? I mean, are they...
Yeah, absolutely. This is an important question because you might wonder, well, most of the tradings in the market is done by institutional investors. And so I will have a slide about this, but just to give you the quick answer is like they are responsible for a smaller fraction of trade. Other papers estimate 8% of volume on any given day is retail investors. They tend to go up to 20% of volume around earnings announcements. So the earnings announcements of a company is some sort of catalyst for them to trade more. And so we will have some discussion about how should we adjust the magnitudes that we find, because this is just a sample, to make it representative of the whole retail investor group. And is this enough? Is this a big enough group to affect prices? And I'm going to argue that it is, although by all means, it's not the biggest group of traders.
Enrichetta, can I also ask a question? There are several papers that document small price bias, which means that when the price is low enough, investors tend to think that the growth potential is especially high. To what extent the behavior bias that you are documenting is related to this bias?
That's a very good point. So in line with what we are saying, we see a bigger effect for those companies that are losers. So they keep going down in price. We haven't separated between losers with low prices and losers with higher prices. And we could do that to try to distinguish. One thing that we do is that we have OTC stocks. These are stocks that are done so badly in the past that they are worth a few pennies. And so they are not trading on the exchanges anymore. But we have, for the moment, we have thrown them away, figuratively. So we don't focus on those, but maybe we should go back and revisit this issue. My expectation is that the effect is going to be stronger. Because once we have the discussion of why is this happening, one of the reasons is that people think that, the market has overreacted and they are going to be better informed, more rational, more wiser, and therefore they do that. So that's a very, very good point.
Thank you.
Okay, so PED is post-earnings announcement drift. And so post-earnings announcement drift just tells you, news come in with the earnings, the price jumps, and I'm going to show you in the graphs, and then it should stay there unless there are other news. In reality, it jumps and then it drifts up or down, depending whether the news is good. If the news is good, it's going to drift up more often than not. And if the news is bad, it's going to drift down. And people try to explain this because rationally this should not be happening. And so we see that this post-earning announcement drift for bad earnings or for stocks with bad earnings surprises is actually stronger when there is a lot of retail buying. So if you look at two companies that have the same bad earnings surprise, the same bad pattern in stock prices going up to now, and if you separate the groups into quintiles, we do, but let's say in general, in groups in which companies that are traded a lot by retail investors and companies that are traded a little, it's only the ones that are traded a lot by retail investors that show this like dichotomy. They show that the price doesn't adjust immediately. The company that do bad and have a bad earnings surprises, but are traded mostly by institution or by others, do not present this phenomenon. So this is true for the losers. So every time retail investor buy the losers do worse than other losers. Every time retail investors sell the winners tend to do worse, tend to do better than the other winners. So they really go in the opposite direction of where they should go. After documenting this, we create also some indices for investors and firms. Who are the investors that tend to be the most contrarians? You see are definitely young people, day traders. So going back to Helene's question, most of the retail investors trade very little, but there is a small fraction of them, about 10% of them, that is responsible for 90% of the retail trading. So there are people that trade super often within the day, every day, and so on. And there are others that are almost dormant. So we'll take this into account. Same we can do for the firms. What are the firms? What characteristics do they have? What are the firms that attract the most contrarian traders around their earnings announcements? And then I'm going to talk about holding returns. And the role of attention. For a subset of these people, we see the clicks on their website. And so we see, does paying attention gives you an advantage or does it hurt you? And it turns out that as a retail investor, at least in this setting, it hurts you. People that pay more attention tend to be more contrarians, tend to leave more money on the table. Okay. So there is, like I say, a very, very large literature on this. Since this is a short seminar, I picked the two papers that are most closely related to ours. One is by Kaniel and co-author. And so what they do is they look at all the trades between 2000 and 2003 on the New York Stock Exchange. And they show that individuals in the aggregate, among other findings, this is not their main finding actually, tend to trade in the opposite directions of earnings surprises. So positive earnings surprise, retail individuals sell. So we confirm this result in our setting as well. The advantage that we have is that we can follow, like they cannot follow a person over time. They just know if the trade is retail or institutional. We have the advantage of following people over time, so we can describe and understand their holding patterns. We can understand whether they have past high returns, low returns, if they have any embedded capital gains, and so on. And hopefully this information will help us better understand why this contrarian, where does the contrarianism come from. Also, we have information on these web clicks that allows us to investigate the role of paying attention. We can tell which type of shares they look at what times, and so on. Another paper that also finds evidence of contrarianism is Greenblatt and Kelohario. They look at the trading behavior of Finnish investors, and they build some buying ratios between winners and losers, and they show that, people tend to buy the losers more and sell the winners more. Okay, so what are our data? We have data from one of the largest US discount brokers. It will remain anonymous, but I'm sure you're familiar with it. The people that we see are about 2.8 million and have about 270 billions in assets. Most of and they are very representative of retail investors. Other papers with other data sets show that these people have similar features. So people in brokerage accounts in the US tend to hold a few stocks. In our sample is 6 to 8 stocks. As a group, they hold the entire market, but individually, they are very segmented. They tend to be mostly men. They tend to be younger when you compare them, for example, to the Survey of Consumer Finances. The head of household in the Survey of Consumer Finances is 54 years old, and here people are 46. So we don't have education, but if you look at their zip codes, they live in higher education zip code, higher income, most likely men, younger. Here, it's a lot of summary statistics, but the message that you should take out of this is that any given account trades on average 30% of the months that they are in the data. So they don't trade that much. The turnover is 10%. So every month on average, 10% of your shares change in your portfolio. And the top 10% of accounts in terms of tradings are responsible for 90% of the trading. Younger people and smaller accounts tend to trade much more.
Can I ask you some, just, do you know, so it's a kind of interesting behavior. So I suppose there are lots of theories why people hold only like 6 or 7 stocks. But is it the case that they hold these stocks and then they trade at the kind of intensive margin, like they decrease their number of shares or they increase their number of shares, or do they go in and out of stocks? I mean, what do you know the trading behavior, and and then they pick 6 of the stocks, or, I mean, I'm trying to understand what they do here.
Yeah, so we don't analyze it directly, but we confirm it in our settings that people have to cluster into types. There are types that buy well-known stocks, Facebook, Apple, and so on. There are types that buy high dividend stocks. There are types that buy blue chips. And so each of them, this is usually not their only in financial portfolio. They tend to have a 401k, they tend to have mutual funds that are well diversified somewhere else. But when they come here, they tend to pick their stocks. We don't know how, although you can see people have certain predilections for certain sectors and all. They tend to trade in and out a lot. If they add another stock, it tends to be a stock in the similar industry. One other reason why people buy stocks is IPOs and being in the news. You will see it in the graphs that when a stock is in the news, a lot of retail investors tend to buy it. So this is what people know about their methods. So they are not really fully diversified. You need at least 20 stocks to be fully diversified, and they tend to load on a certain sector, tech, or a certain characteristics as well. And since we are here and we are having this conversation, the fact that despite they cover the entire stock market, but each of them is so compartmentalized, also helps with understanding why they don't drop out if they lose money, right? They tend to lose money. So if you look in this period, their average return on these portfolios is positive. However, is way lower than the stock market. So if you just look at the return, you're like, okay, I'm making money, I'm making 4%. But if you look at the market, I could be making 7%. So really, that's not great. And also it explains why maybe they don't learn about the fact that contrarianism is bad. Because they have a few earning surprises because they only experience the earning surprises that are relating to their stocks. So I only have 6 or 7 stocks. I do that. Maybe I see a positive return and I don't make the comparison. Also, I'm not going to show these results today, but we see that there is a heterogeneity. So depending on when you buy the stock, it's possible that by being a contrarian and selling upon a positive surprise, you make money. It's just that you would have made more money if you would have held on longer to your stocks. So this is more or less. So when people say, oh, why don't losers disappear from the market? The answer is, well, it takes longer for these people to be wiped out completely. But on average, they are retail investors are becoming a smaller and smaller part of the market as direct holders. Okay, so going back to one other of Helene's questions, what about the magnitude? So comparing this data set to other data sets about retail investors, we can tell they have the same demographics, features, and trading and holding behavior that we observe in other settings. But are they big enough to actually affect prices? And so we do two things to try to document this. So as of June 2014, we observed $264 billion in portfolios, in holdings. And we know from the flow of funds that the household sector in total is 13.8 trillion. So they constitute 1.77% of retail holdings. So anything at the holding level should be multiplied by about 50 if we are willing to believe that these people are representative of the households as a whole. So there are certain reasons to believe they are and certain reasons to believe that they are not. They are definitely representative of brokerage accounts. However, we also know that this group of households could include founders. So Mark Zuckerberg is a household and he holds a lot of Facebook, but probably doesn't behave like these people. So another thing that we do is to try to estimate their size in a completely different way. So we take the total of all the holdings out there, we subtract the holdings of institutions that have more than 100 million under management. And if we do this, and then we benchmark our sample to this total, we see that, again, these retail investors in our sample are about 2 or 4% of the total, depending if you value weight or equal weight. Finally, in terms of retail, in terms of trading as opposed to holding, they are less active than institutions. Another paper with other data shows that retail investors are about 8% of total trading volume. And if you look at our graph, you see that we are between 1 and 3% of total trading. So we are representative, but of course, everything you see, you need to blow up the magnitude by a factor of, if you take 2 to 4%, 25 to 50 times. Okay, so let me proceed to the definitions and then I'm showing you some results. So what we do is like we take all the stocks that these people own and we separate them into groups. We follow the literature. There are like tons of papers on this, and what they do is they separate stocks by size, large and small, because large and small stocks have been shown to behave differently. Then within each of these 2 subgroups, they sort based on momentum. So at a given every month, we look at the past and we say, what is the performance between time t-12 and month t-2? We rank all the stocks and separate them into 5 groups. So within each of these 5 times 2, 10 groups, we calculate two measures. One is the net inflow into that stock from the people in our sample. So buys minus sells, and then we normalize it by the volume of that stock in the market. Another normalization that we make that is very common is to try to get rid of market effects. So in any given day, maybe the market in general goes up or down, but what we really want to know is the surprise and the inflow on that specific stocks, trying to take the market and the general effects out of the picture. So what we do is that we take this measure of net inflow and we normalize by the cross-sectional mean of the net inflows. So that if in a given day there were a lot of net inflows across the board, this gets taken into account. We can also do it over time and we have similar results. The absolute flow is just, how many trades there are on average in that stock. And then the SUE is the earnings surprise. Actual earnings, so and every quarter a company tells you the earnings minus the estimate from the analyst divided by the price, the absolute value of the price the day before. We have several ways of calculating the earnings surprise, and all of them give us a similar result. So we have chosen this one because, well, we think that benchmarking to the yesterday's price, it's a good idea because it's very salient in the retail investor mind. It might already be partly affected by the surprise if people anticipate it, but not that much. Okay, so first result. On the horizontal axis, we have the portfolios. 1 is the losers, the stocks that in the past 12 months did the worst. 5 is the winners. On the left, in this graph, you see the inflow into these stocks by our investors. You see that the inflow is positive, meaning they buy losers and they sell winners, which is the opposite of what they are supposed to do if they want to take advantage of the momentum phenomenon. And here is the absolute, so it's buys plus sell, and you see that they are more active in both the losers and the winners, while they tend to ignore more the ones in the middle. In these slides, I'm going to take the figure on the left and separate out the large earnings surprises, both in the positive and the negative, from everything else. And you can see that in the large earnings surprises is where this phenomenon is the most visible. It is when there is a very large negative surprise, or like when the earnings surprise is big, we see that there is a lot of inflow into the losers and some outflow from the winner. Okay, so then you say, okay, you show me the earnings surprises, you saw the momentum, but how do I know really that, is there any other evidence that shows that it is retail investors that really are associated with this? So one other thing that we do, in most of the presentation, I'm going to use graphs. We do the following. So we build again the momentum portfolio. 1 is the loser, 5 is the winner. But then within each momentum portfolio, so let's say within the losers, we separate out stocks that have very little up to a lot of retail trading. So as you go down in this graph, there is more and more retail trading. As you can see, it is the last two rows, the one in which there is a lot of retail trading, they show evidence of momentum. What do I mean? So momentum means that a good trading strategy is to sell the losers and buy the winners. Momentum tells you, look, going forward, you know that the winners will do better than the losers. So if you take the average, and if you compress this on like vertically, you're going to see that on average, stocks in the portfolio 1 have smaller returns than stock in portfolio 5. But once you separate out, you see that this is true for the subset when there is the most retail trading, is still somewhat true for the second to last. But then if you look at other stocks that are in the losers or the winners, but don't have a lot of retail tradings, you don't see this difference in average return. So the momentum phenomenon is only available when there are a lot of retail trades. Okay, I keep going, and if you have questions, you tell me. Okay, so this was taking an average of the monthly return over the entire sample that we have. However, if our retail investors are really related to our phenomenon, then we should see that the trading commences around the time, the day of the earnings announcement. So this is on the horizontal axis, we have trading days. This is day 0, the day of the earnings announcements. And what you see is that when there is an earning announcement, there is an increase in inflow in all the shares. So the blue line is the losers, is the shares with the worst earning announcement, worst earning surprise. The yellow, no, the grayish, greenish thing, this one is the winners. The stocks that surprise on the most positive terms. And you see that the day of the earnings announcement, there is an uptick in retail trading, regardless of whether you have disappointing news or you have great news. And this has been documented in the past, and people argue it's been connected to attention. These are stocks that go in the news. If you have a Robinhood or a Schwab account, they go up on your webpage, you see about them, and so people tend to trade them. But then if you look at what happens to the in the days following that, you see that for the bad surprises, people keep buying them. So people keep buying these stocks even after there is a bad surprise. They buy a lot on the day and they keep buying. For the winners and the others, on the contrary, yeah, they buy a little more during the day of the announcements, but then on net, they are sellers. We can do this considering both earnings surprises and momentum portfolios. So this is the one on the left is the losers portfolio, the stocks that had bad returns up to today. And we separate out the very bad surprises, this blue line, from the best surprises. And we do the same for the winners. So here you can see that it's not enough to have a negative earnings surprise to go into the losers portfolio. There are stocks with negative earnings surprises even in the winner portfolio. It's really like a subset of these stocks that are losers and they get a lot of inflows. Like they have negative surprises and they get a lot of inflows that end up in the losers. And I'm going to show you this in more detail. So this zooms in on to the loser portfolio with the worst earnings surprise. So you've been doing badly price-wise for 12 months, then you have a surprise and it's negative. And we separate the stocks into this portfolio into an additional 5 groups, depending on how much our retail investors are trading. So here you see the top line is the losers with bad surprises, where our retail investors are trading the least. And down here is the one with the highest flows. So here it tells you the stocks among the losers with bad surprises, the stocks that have the most inflow following the earnings announcements are also the stocks for which the drop in returns is the biggest, and there is a post-earnings announcement drift, meaning instead of having a drop and then a flat line, we have a drop and then the price continues to go down. While there are other stocks that are losers, have bad surprises, but for some reason they don't have a lot of retail investor trading, those stocks actually don't experience that big of a drop. Actually, they go up a little earlier before the announcement, and then their return is about 0. Also, there is a drop on the time of the announcement, but there is no drift because the line is flat, so the price doesn't change anymore. And below down here, we calculate what is the effect. So what is the jump down between time 0, the announcement, and the following day, and what is the additional drift from day +1 to day +22. So if there were no post-earnings announcement drift, the last column would be ones. And likely the second to last column will be bigger because all the information would be incorporated on the day of the announcement. So this is the same analysis, but instead of the losers with bad surprises, we look at the winners with very good surprises. The same is true, although the magnitude, if you compare the y-axis, in the case of the losers, you see here there is a loss of 20%, which is very big. Here there is a gain of 6%, which is not bad, but is way smaller. So this effect is smaller for the winners. There is also less post-earning announcement drift. Like there is a jump, but then more or less the lines tend to be sort of flat. So again, here, these are the winners. The subset of winners for which our retail investors sell the most are the one with the most, the highest drift, although the drift is not that big. Every time there is a drift, gets interpreted as not all information gets incorporated into prices immediately. Here, we are just separating out small versus large companies. The idea is that large companies have more retail investors, they are more scrutinized, they are more in the news, they are more professionals following and analyzing them, so it should be more difficult for the price not to adjust immediately. Indeed, you see that for the small cap on the left, the jumps are bigger. So there is a bigger price adjustment upon the earnings announcement, and also some of the lines keep drifting, which is the post-earning announcement drift. Same is true for stocks with low versus high institutional ownership. And then one thing to notice is that there is a paper in the finance literature that argues that, maybe this phenomenon of post-earning announcement drift was something in the past. So, you take the data, I think CRISP starts back in the 70s. So you get price data still the 70s, you find some patterns, some of them survive and some of them don't. And he argues that, look, the post-earnings announcement drift does not survive. And indeed, if you just separate by losers versus winner, and within each group, bad surprises, the blue line, versus very good surprises, you see that, yes, the price adjusts in the direction we are expecting. If you have bad surprises, it goes down, and if you have good surprises, it goes up. But then the lines after that are pretty much flat. So it seems that on average, all the information is incorporated on the day in which the news comes out, day 0. This being said, if you look into this group and you separate out the cases with a lot of retail flow, then you see that this is not true anymore. Once you take retail flows into account, when there is a lot of retail flow, there is a jump on the day of the announcement, but then there is a huge amount of drift. Mostly for the losers, but to some extent also for the winners. So in some sense, this post-earning announcement drift is alive. It's just like that is confined where there are more retail investors.
Do you have an explanation why so the retail investors behave in that way, and why you seem to see this asymmetry between the winners and the losers? Like it seems to be a bit stronger for the losers than for the winners. So is there a behavior thing behind that, or?
Yeah, we are working on this, but putting in a simple theoretical framework, and also trying to look for other theories or exploit the data more to try to understand. So one theory that has been brought forward among retail investors and would explain this phenomenon is that investors seem to believe in mean reversion. So if you survey investors, you show them price patterns, and there is a paper by Laundenbach and co-authors in 2021 that shows this. So people see different patterns, and then they are asked, what do you think is going to happen to the price? And there is a lot of heterogeneity in the way people form beliefs, but on average, they tend to think that if the price went up, it's going to go down. And if the price went down, it's going to go up, and it's going to converge to some level. There is also very large literature about overconfidence. So people think that their trading abilities are higher than the rest of the market. People that are more overconfident tend to trade more. So it is, and they tend to be men, actually. There is a famous paper that shows that. And so it is likely that these brokerage accounts are actually, it's been shown that they tend to attract people that are overconfident. They're like, I'm not buying a mutual fund where someone else trades, I'm going to do it myself. And so overconfidence is also something that has been shown to go hand in hand with contrarianism. So, you think, oh, everybody else is getting it, doesn't get it right, I know what I'm doing, and so on. And finally, this is also consistent with models of partial equilibrium thinking. Like you think the market is off. You think that all the other retail investors are either too optimistic when there is good news and too pessimist when there is bad news. You want to trade on that, but you don't take into account that probably everybody is thinking the same thing that you are thinking. And so as a result of that, you end up, selling too much when there are good news and buying too much when there are bad news, because you don't realize that everybody else probably does the same. And so the prices are way closer to fundamentals than you were thinking if you were the only one doing this. So these are the three areas that we are thinking of exploiting. Why does it happen more among losers? That's also like one possible reason is because losers tend to have lower prices, like Dong said before, and so retail investors tend to float toward those. But it might also be just a like GameStop meme mentality, or something is going down, but I know that it is gonna come back up. Some sort of mean reversion. And we plan to investigate this more. We only have administrative data, so unfortunately we cannot contact the investor or a subset of the investor to ask them, but we are thinking about ideas along this line. So that's a very good question. Okay, so in the remaining time, I'm going to tell you something about the longer run. So up to now, I've showed you results that are 22 trading days around the earnings announcements before and after. But like I said, momentum is a phenomenon that is more long-lasting. And so we want to see if the pattern in retail trading is consistent with prices and flows at the 6 to 12 month horizon. Then I'm going to talk about alternative explanations, that is not contrarianism, and then a little bit of characteristics of the contrarians in the firms. So here we have we try to see if we separate between losers, middle portfolio, and winner. Do the flows and the return line up? So do our investor flows? So every time, there is inflow into the losers, we should see that the return keeps going down instead of dropping a lot and being flat. So here it's a little bit of a generic way of checking, but let's look at this graph instead. So here we separate out SUE group 1, very bad news, SUE group 5, very good news, and then we create 5 groups. Each graph is a group, depending on how much retail investors are trading. And here you see that among the good news firm, there is a spread, and this is 12-month horizon. So now the horizontal axis is months. In order for us to find momentum, we need to find a return spread between winners and losers. If all the returns are more or less the same, there is no momentum. It's not that you would have made money by buying the winners and selling the losers. And here you see that the biggest spread is among the case in which there are bigger retail trading. Same here. So specifically among the losers, the bigger spread is when there are there is the most buying. The retail inflow is the highest. Among the winner, there is the biggest spread across the several groups, across the various momentum portfolios, for the group where the inflow is the most negative. So when they sell the most, then there is a bigger spread among the good news. When they buy the most, there is a bigger spread among the bad news. So I'm going to talk a little bit about alternative, and maybe then we can make the discussion more about, why is this happening, and can we find some theory of the way retail investor reason that can explain this finding. So the biggest alternative explanation is the so-called disposition effect. The disposition effect is the tendency to hold on to losers and sell winners. And it comes from it comes from prospect theory by Kahneman and Tversky. People feel uncomfortable and it's unpleasant for them to realize losses, while they feel very, very good when they realize gains. And so all else equal, there is this paper by Odin, and there are many others after that show that people are more, at any given point in time, people are much more likely to realize a gain than to realize a loss when they trade in their portfolios. And so you can see how this is similar, right? Because if there is a positive earnings surprise, then the price has gone up. So all else equal, I am more likely as a trader to have a gain in my portfolio. You see me selling. Am I a contrarian, or am I just somebody that has this position effect? Likes to sell winners and dislikes to sell losers. So we do two things to try to separate these two. First, we double check that in our sample, there is the disposition effect. So are our investors strange, or do they also have the disposition effect? And this is the first, let's do this. This is the first table. So you can see that if anything, there is a bigger disposition effect in our paper than in Odin. Or, more or less is similar, but we confirm that there is a disposition effect here as well. However, we also show that if you zoom in around earnings surprises, the trading behavior is not explained by the disposition effect. So what we do is the following. Every time there is an earnings surprise, suppose Apple as an earnings announcement at a certain point, we take everybody that has Apple in their portfolio. At the moment, we only check selling. So we take everybody that has Apple in their portfolio, and we consider all the other stocks that they have in their portfolio as potential candidates that they could have sold instead of Apple. And then we ask ourselves, okay, did you sell Apple? Yes, no. Did you sell something else? For each person, we calculate the unrealized gain, depending on when they bought Apple and at what price. Some people will have a gain, some people will have a loss, some people will have, so different people have different embedded gains. And we check, does having a gain affect whether you sell? No. If you see the first line is in the first column, is like the gain is not a significant determinant. Does having a positive surprise determine whether you sell? Yes, you're more likely to sell. When we put the two together, is still the earnings surprise that is the most significant determinant, both economically and statistically, of selling the stock. And also, it doesn't matter really, conditional on having an earnings surprise, whether you have a gain or not in your portfolio. And the first three columns are calculated with all the traders. Then we separate out the people that are very big day traders. They trade a lot, and you can see that most of the results come from them. It's the people that buy and sell intraday over time, over these months, that are the ones that generate this contrarian portfolio. So they buy early in the day or at some point in the day, and they tend to close within the same day. For them, it doesn't really matter whether they have a gain or not. Actually, it seems that having a gain has a negative effect, and this is column 4. Finally, in column 5, column 5 is the complementary group, the ones that hold on the stock for longer. And finally, they tend to be slightly more momentum, like they go more with the flow. We need to figure out whether it's mechanical or not. And finally, the last column, column 6, takes into account the fact that earnings announcements tend to cluster in time. And so, it's possible that if I'm buying and selling another stock that is not Apple, it's just because there is another earning announcement. And you see that this effect is even stronger. Finally, another thing that you might wonder is maybe people put a limit order and then they forget about it. So, I don't know, 3 weeks before the earnings announcement, I put a limit order that says, sell if the price ever reaches $300 or more. And then I do nothing. Of course, if there is a positive earnings surprise, there is a higher likelihood that the price is going to hit my limit order. So maybe it's not really being contrarian, it's just mechanical. And we show that that's actually not the case. Finally, we ask ourselves, what are the investors and the firms that get most contrarians? So the blue graph tells you for each person, so the way it's built is that we take a person and we calculate the fraction of contrarian traits that they have around earnings. We focus on people that have many traits, at least 12, I think, in this picture, just because otherwise you're either 0 or 1. And we see that there are people that are never contrarian. There are people that are always contrarian, but most of the people are sometimes contrarian, sometimes not. And so it's going to be interesting for us as a next step to figure out why. Is it a feature of the stock? Is it a feature of the announcements? What's going on? Same for the firms. There are some firms that have no contrarians in our sample. So every time they have an earnings announcement, they don't have any contrarians. And then there are firms, most of the firms, of course, are somewhere in the middle, and then there are firms that only have contrarians. And of course, we do some correlations here to try to see what are the features of these firms that are more likely to be associated with contrarians. And so this is a list of them. Maybe I refer you to the paper to see what are the features that are more connected to contrarianism. One other thing that we check is if there is some pattern across the years. So is there one of the years in our sample in which something happened and maybe that drives the result, and it's not the case. Finally, I'm going to talk about the role of attention and leave 5 minutes for the question. So for the subset of people for which we observe the clicks, we also check whether when they trade around an earning announcement, they have a special pattern in their clicks, whether they log in, how long do they log in for, whether they check the research page, whether they build watch list. So on this website, you can build a watch list of the shares that you are interested in following. If you own them, it's automatically in your watch list, but you can add others. And, you're going to receive emails, news, alerts when something happens there. And so what we find is that is visit means this person visited their website. It wasn't only for trading, and they stay there a certain number of minutes. So is visit is a positive determinant both of buying and selling the stock. So when people pay more attention, they trade more. Either way. However, earnings, when the return that the stock has around earnings announcement is so if the return is positive, it's more likely that they sell. If the return is negative, it's more likely that they buy. They are contrarians. What about the interaction between paying attention, visiting the website in advance, and perusing the research page, and the earnings return? So we see that for selling, there is no significant effect in the interaction, but for buying, there is. And so all else equal, earnings returns are, like the effect of earnings returns is amplified for those who pay more attention. So those that do the most research are the ones that tend to buy the worst losers. So, if returns is negative, all else equal, this group will buy. But if it's a group that was very active and paying attention on the website, they'll buy more. They are more likely to buy. So they go in the opposite direction. We look at holding periods. We look at factor exposure. Here is the discussion that we had following Helene's question of, where do you think this comes from? And this is the direction that we are going to go next. Conclusion, we provide evidence that retail investors trade as contrarians, following large earning surprises, both positive and negative, and in doing so, they contribute to momentum. They slow down the adjustments of prices, and so they contribute to the fact that winners continue to be winners and losers continue to be losers. We show that indeed, if you just look at the momentum effect, is disappearing over time. But if you zoom in each of the portfolios to the stocks that have the most retail flows, those are the stocks where momentum is still strong. find that the effect is larger for small stocks, loser stocks, stocks with low institutional ownership. I didn't mention it when we look at the index, but it turns out that it's younger traders and traders that trade intraday that are more likely to be contrarians. And then these are some firm characteristics that seems to be associated with higher contrarianism. Future research, we have expanded the sample to the more recent period up to the end of 2022. And also we are going to look at the clients, not only of one brokerage firm, but a lot of them, in case there is some, specific clientele effect and this brokerage firm is not representative. And we plan to work more on the trading horizon and the investor returns to better understand why is it that people behave as contrarian, when do they behave as contrarians, and who is more likely to do so. Thanks a lot. I wrote down the questions while we were speaking. If you have any other questions, either now or later for the discussion, please go ahead.